Thank you for joining us for this Richey May webinar. Today our topic is the guide to being Pitchbook perfect. I'm just going to go through a couple housekeeping items, and then I'm going to turn it over to Steve Vlasic, one of our partners here at Richey May, to do the introductions. All participants today are going to be placed on mute, so if you do have questions, if you look in your webinar dashboard, you do have a questions feature. So please type your question there. We will receive those and hold those to the end after the presentation and address them then. If we do run out of time and don't have the ability to answer all questions today, we will follow up with you directly and individually to ensure that all of your questions are answered. And finally, a recording of today's webinar as well as the slide deck will be emailed to all participants. So please do look for that via email in the next day or two. And with that, I'm going to turn it over to Steve Vlasic.
Hi, everyone. My name's Steve Vlasic, and I'm a partner here at Richey May. We are a CPA firm that specializes in alternative investments. I just wanted to thank all of our clients and friends in the industry for joining us for this webinar, Guide to Being Pitchbook Perfect. The reason why Richey May and ImageArb decided to host this webinar is because when we speak with our clients, raising capital is the most common question we receive. So we just wanted to bring some value to the industry, make things a little easier for everyone. We hope you find this webinar beneficial. And now I'll hand this over to Megan and Blaine, who are Pitchbook experts that do great work for many of our clients.
Thanks so much, Steve. This is Blaine Smith, and I want to thank you for joining us today. We think this is a very important topic for every investment manager. In order to raise capital, you must do the following. You must establish and nurture relationships with potential investors, and you need to clearly communicate how your approach or strategy will identify opportunities, generate returns, and add value and diversification to the investor's portfolio. Collateral, along with your verbal presentation, plays a critical role in this process. A thoughtful approach to both your business and your operations is also important. Collateral typically consists of your written presentation, your fact sheet, your website, and quarterly investor communications. Today, we'll be addressing the written presentation or pitch book.
Good afternoon, everyone. My name is Megan Nicholson, and I run ImageArb along with Blaine. Thank you so much for joining us. Just to give you a little background on what ImageArb is we are a strategic communications firm that is solely focused on the investment management business. We help investment managers articulate their messages and really put their best foot forward when speaking with potential and current investors. A little background, Blaine founded ImageArb in 2011 after raising institutional capital successfully for several hedge funds based here in Dallas. I came to the business after also raising institutional capital both in-house for corporate credit and convertible arbitrage hedge fund, and also on the more corporate side in various functions within the prime brokerage universe for the past 10 years. So together we like to joke that we've managed and run thousands upon thousands of meetings with institutional investors across the world. We work with a wide variety of structures and strategies, including hedge funds, private equity firms, venture capital funds, long-only funds, family offices, funds of funds, and wealth managers. And we both have experience across long-short equity, global macro, sector specialist funds, private credit strategies, quantitative, systematic, crypto assets, angel investing, mineral rights, real estate. You get the picture. We'll try to weave thoughts for public equity, private equity, and crypto assets throughout this discussion.
Okay, let's get to the purpose of the pitch book. Let's be honest, very few of you want to work on your messaging and positioning. You want to manage your portfolio. And further, we find that some managers believe the written presentation is not of much value, and they place far more emphasis on in-person meetings and calls. When we offer advice to these managers about their pitch book, they protest something along the lines of, well, I can explain that in person. However, without a well-thought-out pitch book, you may never have the chance to give that additional color in a verbal presentation.
Remember, the pitch book needs to communicate your value proposition or tell your story in a way that is both accurate and that casts your strategy in the most attractive light. The goal is to pique a reader's interest so that you can get that conference call or that in-person meeting. The process of raising capital is unfortunately lengthy. From the initial introduction, you'll move to a series of calls and meetings and finally progress to in-depth due diligence. The pitch book is just one step in this process. Prospects will no longer refer to the pitch book after the first couple of meetings or calls. The pitch book can also extend your reach and make your marketing more efficient. It should be able to stand alone and describe what you do even when the reader does not have benefit of hearing your verbal presentation. Remember that your strategy is filling a need for an investor. The information in your pitch book should enable the investor to begin thinking about where you and your strategy fit within their portfolio.
Now we'll move on to rules of thumb. Several of you asked about presentation length. We find that the optimal length for a presentation is around 15 or 20 slides, excluding the appendix. There are some exceptions to this rule, but in the hundreds and hundreds of pitch books we've read, we've never seen one that really needs to be 40 plus slides, although presentations of that length are circulating. Now, content elements. Regardless of structure or strategy, there are certain things you'll want to cover. First of all, your investment philosophy. This gives you an opportunity to differentiate yourself with your beliefs and describing the why of your approach. So think about opinions here, elements that are not facts, but are rather positions you've taken based on your observations or experience. So for example, if you're a long-short manager, you may have strong opinions around hedging using ETFs or only shorting single-name stocks. You'll want to give the reader some insight as to why you do what you do. On crypto assets, we've worked with firms who strongly believe that they will only invest in Ether for various reasons. They will not consider Bitcoin. Things like that, you need to explain why you feel that way and why your approach has been developed over the course of your experience. Another long-short example, we have managers who perform research, more deductive research that leaves no stone unturned. So they're going to track down every manager they can talk to, every vendor they can talk to, read every sell-side analyst report, versus we have other managers who are more inductive reasoners, or they focus only on a small number of key drivers. Again, the philosophy is why you do what you do. Philosophy even goes for quantitative or systematic strategies. You've written your model or algorithms based on beliefs about the market and its behaviors, and you want to share that with your prospect. Okay, so that's investment philosophy. Moving on to investment universe. The universe, you need to give your reader a sense of what you will and won't invest in. So for example, if you're a private equity manager, are you looking at revenue or EBITDA metrics? Are you focused on particular sectors? Are there things you absolutely will not address? If you're a public equity manager, are you looking at domestic equities, global equities? Do you exclude biotech? Do you exclude financials? Are you unwilling to invest in frontier markets? You get the idea here. Your universe can be defined by geography, by asset type, by market capitalization, by sector, but you really want to define what you will and will not consider. Okay, after you talk about your investment universe, you will want to give the reader a sense of how you go from that universe to your portfolio. How do ideas make it into the portfolio? So that often begins with idea generation. So for long-short equity or crypto assets, you'll want to give the reader an understanding of narrowing down your investment universe to construct the portfolio. And this is especially important if you're just a one or two person shop. You have to be mindful of resource constraints in that instance. So are you using screens? Are you leveraging relationships? How are you making that initial cut? In quantitative or systematic strategies, you'll want to give an overview of metrics that enable a stock to enter the model's consideration. Then you'll want to move on to describing your research process. So we've touched on it, but long-short equity, are you doing financial modeling? Are you meeting with management? What are your inputs into that financial modeling? With cryptocurrencies or crypto assets, are you meeting with development teams? How are you doing your research and analysis? If you're on the private equity side, what are your main criteria? How are you engaging outside partners to diligence the opportunity? How do you think about making an impact once you've infused capital? Now, you need to consider your audience, and that's especially true with crypto assets or with more niche strategies. You need to frame your strategy for more traditional asset allocators, like family offices who maybe don't have a lot of primary experience with the space, if you're going to be approaching those types of investors. So we'll get into education a little bit later in the call. Okay, so after you cover your research process, ultimately, how do you make that investment decision? That's something that you need to outline in your presentation. How are you establishing a position? Do you take a small position early in your research process and then increase your position size as conviction increases? Do you trade around your position? Is the ultimate investment decision made by committee? Do you have to gain consensus internally amongst many decision makers, or is there a single decision maker? And then next, you'll want to articulate your exit criteria. How are you thinking about price targets? How are you thinking about the sales process? We also suggest that you describe what your portfolio looks like, portfolio characteristics. So that might include things like ranges for number of positions, long and short, exposures such as market capitalization, geography, sector exposures. It can be a liquidity ladder. It can be, you want to set the expectation for securities or assets that the investor can expect you to hold. So if you're primarily an equity fund, but in certain cases you will invest in credit, that should have come up before this page, but you'll want to give the reader a sense for the allocation amongst those asset classes. Risk management, very important for anyone on this call. You'll want to articulate limits with respect to position size, sector exposure, net exposure, again, liquidity. That's always a concern for investors. You might want to address what happens in the event of a drawdown. So do you utilize stop losses? If you experience a drawdown of 10% or 15% or whatever the number is, are you automatically re-underwriting your thesis? Those are the types of things that you'll want to put on your risk management page.
Now, sometimes rules should be broken. If a strategy is not widely understood by the investor community, the presentation will likely want to extend beyond sort of the recommended length to include an educational section. Two examples of this, where this approach may be appropriate, are in the cryptocurrency and mineral rights markets. And finally, you'll want to make sure that you include a listing of your terms and service providers. Investors will want to evaluate you based on who you have chosen to partner with, and your terms may open or close the door before you even have that initial conversation. So definitely make sure that those are listed at the back of your presentation.
Okay, after working hundreds and hundreds of clients, we've noticed some recurring mistakes, and we want to cover those for you today. So mistake number one is what we call the podium pitch book. That is content that would be more appropriate for a spoken presentation at a conference. So if you're at a podium speaking to an audience and you're putting up charts and graphs or certain phrases that you have the ability to put your language around, that's obviously different than this presentation, which, as we've mentioned, needs to stand alone. So the podium pitch book might include bullets or phrases that don't make any sense on their own without additional color, or wide gaps in the narrative where that's just simply not appropriate for a written pitch book. Again, I can't emphasize enough how important it is that this stand on its own, because what you ultimately want in extending your marketing reach is for someone you speak with to be so excited about the opportunity of investing with you that they pass this along to colleagues internally or their network externally. And there's such constraint on the allocator's time that you really need this to be able to tell your story when they don't have benefit of hearing you talk about it. Mistake number 2, playing Where's Waldo with key messages. What that means is if you fail to get your most important takeaways across in the first 4 or 5 slides, again, going back to allocator resource constraints, too often we've seen that managers will start their presentation off talking exhaustively about market conditions rather than their own strategy. I mean, we've gotten to page 15 or 20 before on a presentation that's been sent over by a prospect, and we still have no idea what they're doing at halfway through the pitch book. That's bad. With a few exceptions, we do not recommend spending a lot of time up front on market conditions. Maybe a slide is fine, particularly if it's something that is not an ongoing opportunity. That makes sense, but you really want to avoid spending your first 5 or 10 slides on that kind of a setup around your opportunity. Remember, readers are sometimes only going to look at the first few slides before they decide whether or not they're going to take a meeting or call. So if you're a small or pre-launch fund, those first few slides should definitely highlight the principal's experience. At this stage of your life cycle, the success of the strategy is very, very manager-centric. We generally suggest an executive summary up front that gives a bullet or 2 on the firm, when it was founded, who the principals are, the strategy, your objectives, and your portfolio. Again, the portfolio characteristics we just talked about a little bit ago. Number of positions, exposures, set their expectation for what that's going to look like. And then after the executive summary, we would say that there are a few more slides you need in no particular order. The principal's bio, key strengths of the firm or approach, and then your track record if you have one.
The third mistake we often see is unfathomable charts and graphs. You don't want your reader to expend too much mental effort to interpret charts and graphs. Draw a conclusion for the reader. The point of the slide should be written out in a sentence or a phrase. The fourth mistake we see often is information overload. We've already mentioned the 40-plus slide presentation. Remember that you're not trying to avoid a due diligence process with this document. Any investor will have multiple meetings with you and possibly an operational due diligence evaluation before writing a check. The pitch book should be a fairly detailed overview that effectively showcases your strengths and answers most questions an investor would have during an initial evaluation. Again, the goal is to get to the next step of diligence. And the fifth mistake that we see often is what we call the secret sauce mistake. We believe the secret sauce is generally a myth. Transparency engenders respect. And besides, if someone can precisely replicate what you do after reading through 15 pages, then we would argue it isn't worth 1.5 and 20 or whatever fee structure you use. Describe what you do. Don't be too cautious about providing details. This goes for quant strategies also. Don't hand the reader your model, but also don't avoid details about the strategy out of fear of it being replicated.
Okay, I'm going to move on now to talking a little bit about graphic design. I don't want you to underestimate its importance. Nobody is going to allocate capital to you because of the colors you choose or how your logo looks. That's obvious. But that said, you can change your content in your investor presentation on an ongoing basis. But you really can't change your visual identity, your logo and your colors and that sort of thing very frequently. You want to set yourself up to be consistent from the beginning. Obviously, most people in our business would avoid the color red in their logo. Don't want to evoke any drawdowns. For the presentation itself, professional graphic design will convey professionalism and visually organize important points. That way, the reader can more easily digest the information you're trying to convey. So what we have here on your screen is a before and after. The before is a track record slide that we received from a client. And the after, you will see that it's much more easily readable. And we also put together a summary sentence at the beginning that would draw a conclusion for the reader. This shows that the firm has experience and has outperformed their benchmark. So you're not only conveying the information about the track record, but you're also reiterating your key points. And that's critical. This is obviously a track record slide. I could show you dozens upon dozens of examples of investment process overview, research slides, where we've been able to improve the takeaways with professional graphic design. I know that early on in the life cycle of your fund, you're trying to save money, and you may be tempted to avoid spending money on design. But I want to give you some food for thought. So think back to the last time you bought a home. I think this is analogous to the situation. And hopefully many of you have at least looked at purchasing a home before, and this will make sense. Most home buyers, you go out, you tour numerous properties before you make an offer. You spend a couple of Saturdays with your realtor, and you're allocating really limited time to deciding whether a house is a serious contender. If you're looking at 5 or 6 houses in a day, you're not going to spend 2 hours in every one. You contrast a clean and inviting home with fresh interior paint, appealing finishes, and maybe some nice smelling candles burning in the kitchen. And then the next house you go to, there's weeds in the yard, there's a broken marble tile in the entryway, there are pet stains on the rugs, there's a leaky faucet in the master bath. I mean, you get the idea. In the back of your mind, you might wonder if the previous homeowner's neglect would extend to a lack of major system maintenance. What are the chances you're faced with unwelcome and expensive surprises after you move in? Are you going to have to replace the entire HVAC system because they didn't change their filters? Many of prospective homeowners just wouldn't take the risk. Now, where does this fit into our discussion today about graphic design? A prospective investor must frequently make decisions based on limited information. You have to make the decision to either showcase your offering with compelling ongoing communications, or you risk losing the investor's attention and the opportunity to develop and deepen your relationship. Your elevator pitch and PowerPoint presentation certainly won't win you the business, but a lack of attention to your pitch and your presentation can quickly cross your offering off the list of contenders. It doesn't matter, again, whether you choose blue or green for your logo or whether your font is serif or sans serif. What matters is that you and your firm and offering are perceived as professional, thoughtful, and consistent.
Investors see dozens and dozens of presentations, and the bad ones stand out just as much as the good ones do. That goes for design as well as content. Industry standards are moving towards professional graphic design, so it stands out when a manager dumps language into a standard template. This is such a small investment relative to other startup costs like fund formation, et cetera, but it can really derail others' perception of you and your firm. Finally, one small but important point. After participating in many investor meetings, we recommend utilizing a design that is easily readable when printed so that it avoids tons of photos, for example. We also recommend utilizing white space so the reader can take notes on the printout if they wish.
Okay, so how do you go about actually implementing all this advice from the call today and creating your presentation? So that's a tall order. I want to talk to you a little bit about the ImageArb philosophy. So first of all, we believe that perfection is the enemy of excellence. It is worth the time and money to do this right, but don't obsess. Collateral lives and breathes, and you can alter your pitch book 6 or 12 months down the road if you find you're getting the same questions over and over and you realize your presentation does not address a critical point. Try to achieve a balance of creating a compelling presentation and driving yourself absolutely crazy with the implementation. Okay, secondly, you can't be all things to all people. Be honest, answer the question, be clear, and don't try to use esoteric words or gloss over a topic because you don't really want to go there. You ultimately want sticky capital, and being honest and upfront promotes that outcome. The written presentation should have broad appeal. Unless we're talking about a huge firm with multiple products and almost unlimited resources, if BlackRock is on this call, this does not apply to you. It's really unnecessary to have a separate presentation for high net worth versus family offices and a separate one for consultants and the endowment and foundation community. You're going to have the opportunity to tailor your communications by investor type through your email introduction and your verbal presentation. We want to talk a little bit about what we term knowledgeable objectivity. We think it's important to work with someone who can provide this to you, someone who understands the business, but can also be objective because it's really difficult for you to be objective about your own business and your own story. It's difficult for me to be objective about my business and my story. I mean, we actively work to get outside of our box and think about different things. So how do you get that knowledgeable objectivity? Well, you can hire ImageArb, but beyond that, we would suggest that you should circulate your pitch book to people in your circle who can really understand your potential investors. Get feedback, but realize you cannot implement 100% of feedback. That will drive you crazy. Everyone has an opinion. If you get the same comment or question repeatedly, you know you need to make changes. Remember, not every manager or strategy needs to raise huge amounts of institutional capital. There is no one path to success. We have friends and clients who have built wonderful businesses with fairly modest amounts of capital. So don't set yourself up for thinking that there's only one goal and it's X amount under management. That's the wrong approach. There are lots of different ways to achieve success. Your presentation, that said, your presentation still needs to be a quality product before you approach high net worth investors and family offices. Family offices are not dumb money, and unfortunately, we see too many people who think that they can delay focusing on this project until they are ready to reach a different class of investor. We think that's a mistake. The process of putting together your pitch book should also help you refine your verbal presentation. I mean, that's by default. If you aren't organized enough to get your content into an easily digestible pitch book, you're going to risk word salad in your verbal presentation. So one helps the other.
Now, how you use your pitch book in a meeting or call will depend somewhat on the person who's sitting across the table from you. Some investors prefer to take the lead in the meeting and will ask questions and direct the conversation. Others let you have the floor until the end when they ask questions. And many investors will want you to send the pitch book by email ahead of the call or meeting. Don't hesitate to do so. Just be sure to send it in a PDF rather than a PowerPoint. In general, most managers will refer to a handful of slides during the meeting rather than flipping through the pitch book page by page. We find that the strategy overview slide, the process overview slide, the investment approach slide, and the portfolio characteristics slides are frequently referenced during a meeting to provide visual context. We'll save verbal presentation pointers for another time, but it is important to be thinking about answers to key questions, such as lessons learned during a drawdown or a write-off. In putting together your written pitch book, you'll hopefully have come up with your 4 to 5 key takeaways, and you'll want to reinforce these takeaways throughout that meeting. Bottom line is, know your audience, go with the flow, and absolutely follow up after any call or meeting. With that, I think we're kind of done with our section. We'd love to open it up to questions. We have received several questions throughout the presentation, and I'm going to go ahead and read some of them here. The first question we received was, how many pages of the pitch book should be allocated for the fund's performance?
The short answer is it depends. You should definitely, in the case of a public equity strategy, you should be showing monthly returns in table format. You can also, there are lots of elements you can add to your performance page. Generally, most managers have 1 to 2 pages for performance. It could be that table of monthly historical performance. It could be the growth of an initial investment relative to a benchmark, which is obviously very helpful to illustrate visually if you've outperformed your benchmark. It could be things like volatility, standard deviation, beta, Sharpe ratio, Sortino ratio. You could also, sometimes it's interesting to show how the strategy has protected capital during times of market duress. So we've had clients who have shown looking back, the quarters when the S&P was down, how they performed on a relative basis, if that's attractive. So those are some things that you could include on your performance pages, but generally 1 or 2 pages in the body of the presentation will usually suffice. You might have some additional information in the appendix, and it just depends. It's strategy specific.
The second question we received was, should both the fund's gross and net return be included in the Pitchbook or just the net return?
I don't think, it's not a huge mistake to show gross return, but I think in general, allocators are so used to seeing net returns that that's preferable. So I would say stick with net return, and in general, that's going to be the way to go.
The third question we received is, should the manager include his or her story in the Pitchbook? For example, why he or she formed the hedge fund, or should they communicate this verbally to the investors?
Okay, a couple scenarios here. It depends on, of course, the allocator is going to be thinking about where the founder's strengths really are, the portfolio manager's strengths really are. Is it in building a business? Is it in the analyst role, or is it as a portfolio manager? If you really enjoy the analyst role, they're going to wonder why it is you're starting your own firm. So, that's definitely not something to be addressed in the written presentation. In general, I think this is something that's best saved for the verbal presentation, though there are some exceptions to that. I mean, it could be addressed if you think it's something that you want to memorialize in the written presentation. It could be addressed in either the principal's bio or on the investment philosophy page. So if the principal, for example, the portfolio manager, has a tremendous breadth of experience across public and private equity, analyzing all different types of securities up and down the cap structure, maybe that's something you want to articulate in philosophy, that you see a particular opportunity to leverage your background and your breadth of understanding to address current market opportunities. So most of the time, I think save it for the verbal presentation, but in some limited instances, you can put that in the bio or in the investment philosophy.
All right, the next question we have is, how do you market a new strategy such as cryptocurrencies without having a substantial track record?
Marketing without a substantial track record is always tricky, and that's really where the Pitchbook does come into play heavily. This gives you the opportunity to talk about your approach, to talk about your philosophy, why you think you're going to be able to do this. How are you putting together an unconventional portfolio, an unconventional strategy? How are you doing something differently? So that's really the way to give people, and they're going to want to, most allocators, I don't want to speak in generalization, but most allocators are going to want to watch you for a while, unless they know you well or are specifically focused on making allocations to emerging managers. But often you're going to be on a watch list for a while. So just realize that is part of it. We don't think managers should set their expectation that the marketing cycle is 3, 4, 5 months. It's generally much longer than that.
The next question we received is, how long should my track record be before I start capital raising?
So again, that goes back to, there are many different allocators have many different mandates. So there are some out there that specifically have a mandate to look at emerging managers, because we all know the statistics around alpha generate as a fund is smaller earlier in their life cycle, and everybody has a hypothesis about why that is. They're hungrier, they're not asset allocators yet. I don't need to repeat that narrative. I think most of you are probably familiar with that. So I think for larger, more institutional investors, there is something kind of magical about crossing a 3-year track. That said, again, there are mandates that are looking for example, women and minority firms early in their life cycle, or emerging managers in general. So it's really about finding, again, going back to the concept of investor fit. There's no one answer, but again, knowing that there is something a bit magical about that 3-year track.
The last question we received ahead of time is, what are the best ways to attract potential investors to my fund?
That's such a big question. we've covered part of that today. I mean, you want to be thoughtful in putting your best foot forward. That goes for collateral, for your verbal presentation, for staying organized in outreach. I cannot overemphasize the importance of follow-up. I mean, we've worked with managers who are just not sure how to do that. They're just not sure how to follow up. And so how do you attract people? Well, you articulate your value proposition first and foremost, and then you stay in front of them. Not going back again, philosophically, you're not going to be all things to all people. So you're not going to have a very high hit rate, but you have to talk to a lot of people to find those investors that will be the proper fit for you and your strategy. So after you've articulated your value proposition in a thoughtful way, you're going to want to follow up. For example, keep notes in the meeting or the call. What did you talk about? Which of your positions did you discuss? And that goes regardless of what your strategy or structure is. Memorialize those notes. And then if there's an article 6 weeks later that's published about a position, that supports your thesis, or, as an example, I mean, we've had managers who have invested in a particular name because they thought they were going to spin off a division. Well, when that happens, whether that's a month later or 3 months later or 6 months later, you can go back to your notes, who you discussed that thesis with, and then follow up with them. Hey, just wanted to circle back. I know we discussed this particular thesis about the spinoff. I just wanted to, hopefully you saw in the news that this happened. Here's the impact on the portfolio. Remind them of how your investment process led you to allocating to that name. It's a lot of blocking and tackling, and there's no easy way to do this, but it is possible. And again, there's no one path to success.
Do we have any other questions?
We do. We have a few questions that came in through the dashboard. The first one is, how do you feel about using iPads in meetings to walk through the presentation versus a printout of the deck?
I think it could go either way. I don't think that there's any one right answer there. I find that it's sometimes helpful, and Meg and I see this frequently, that the investment manager, the portfolio manager, will send ahead the presentation in PDF form ahead of the call to give the prospect an opportunity to sort of flip through it and make a mental list of questions prior to the call. Sometimes they're printing it out, usually in black and white, so remember that. Sometimes not. Sometimes they're going to make notes, in a Word document or on the PDF or whatever. So I don't think there's any one right answer. I think you can be successful either way, between an iPad or a printout.
Great. So next question, on average, how long will allocators take to invest with emerging managers with 1 year of experience?
It depends on what that year of experience looks like. So if that year of experience is someone who got out of business school and spent 1 year at, name, large, well-known fund, and then is going out on their own, it's most likely going to be a much longer cycle than if by 1 year's experience, you mean someone who came up through the analyst ranks at a larger fund over a much longer period of time and spent a year managing a portfolio within a larger fund before spinning out on their own, or had the career trajectory that I just described, and then that 1 year of experience comes under the auspices of their own firm. That's going to be those two are going to be a shorter cycle than the first description. Still, I think you need to set your expectation that it's 12 to 18 months of discussion. Go ahead.
The other thing I would add is that, obviously there are investors who specifically look for managers under that emerging manager moniker, and that definition obviously varies, but it could be including the 1 year and under of track record. Those are the guys who are looking for people who have not been discovered by other institutional investors. I do think, though, that even though those investors are specifically looking for the earlier stage managers, the length of due diligence is still somewhat the same. It unfortunately is not the way that it used to be, where you're introduced to an institutional investor and they could potentially pull the trigger within 3 months. It's just the environment has changed such that now the typical range is just pushed out further.
That said, the good news is that 7 or 8 years ago, the conventional wisdom was the prevailing sentiment amongst elevators was heavily in favor of the much larger, well-known firms. They were known quantities. The pendulum has certainly swung back toward more openness to considering emerging managers. So it's far more in your favor now than it would have been in the early 2000s.
And that goes for niche strategies as well. People looking to diversify their portfolios away from the more traditional, long, short generalists or long only managers into more niche strategies is definitely more prevailing.
Because they're looking for uncorrelated return stream as well. So if you can demonstrate that you are generating a return stream that is uncorrelated to other things they might invest in, that can be a helpful key attribute toward getting you some more attention.
All right. So one final question here. Where can we look for allocators who are open to emerging managers?
Well, that sort of depends on the type of manager you are and who your service providers are. We can just use hedge funds as an example. Obviously, there's a pretty well built out network of service providers that can point you to the correct types of allocators these days. So, for example, capital introductions teams on your prime brokers. That's a great first way to open up your eyes to who the emerging manager allocators are and what that landscape looks like. What we've been seeing outside of the hedge fund space is a movement towards a consolidation of service providers, for example, for private equity, VC managers, et cetera. However, I think that's still sort of in its nascent stages. So it's a bit harder to retrieve that list of allocators for those types of managers at this point. But for the hedge fund side, and that includes the crypto fund, I do think going to a prime brokerage firm that has a built-out capital introductions team can help you get at least an initial idea of what the landscape is for those types of investors that are going to consider a smaller emerging manager.
All right, great. Well, it looks like that's all the questions we have for today, unless anybody has something they want to type into that dashboard, that question section quickly. So with that, we'll just thank Megan and Blaine here today for a great webinar. I think everybody learned a lot. You do have their contact information on this last slide. If you do think of something after this, and certainly you do have the contact information for Richey May as well. So please do reach out if you have questions following this webinar. Just a reminder that we will also be sending out a recording and a copy of the slide deck for all attendees today. So look for that in the next day or two via email. I want to thank everybody for attending today. Thanks for a great presentation, Megan and Blaine, and have a great rest of your day.
Thanks so much.
Thank you.